Right, chapter 7. So, the conceptual framework, a measurement. So, just discussing a couple of ideas here with this. We start off talking about the what we have always done and the sort of stability or certainty of it from a measurement point of view. There's an assurance, isn't there? There's an assurance with the historical cost method because one we when we bought the thing we were very clear there was a very clear transaction price. So the cost concept, if you studied accounting some time ago, was a very strong one because the whole idea was that we can verify it, we know that's the cost, we can see the invoice, that's what two willing parties exchanged on this, agreed on this, and that's how they recognized it. And so historical cost is been with us, of course, forever. And then what we then discuss is this use of the asset over time. So we spend the first video looking at that, and then again, because we've been discussing this question of relevance and more relevance, I would say, as opposed to faithful representation. But the fact that people need to be able to make decisions based on these figures, and maybe historical cost isn't quite representative of that currency, if you like, so to speak. Right. So let's jump in. So this is some of the things we'll be doing. Like looking at ads and disads of historical cost accounting, and then we'll move on from that to sort of say, well, what's new, and really what's new is this idea of current value accounting, like looking at things in the now, so to speak, and then discuss that. Okay, so bases. There are a number of measurement bases mentioned in the framework, of course. Historical cost, which we know and talk about a lot. Current cost. So this is, again, like I say, dealing with the currency of events as to what's going on right now within the organization and trying to make it relevant. So all these ideas of this current cost, they appeal to the idea of relevance, if you like, and they give a better figure, so to speak, in terms of having a starting point to make a decision. We discuss fair value, if you like, and value in use, which we saw at impairment when we talked about that. If you remember, when we talked about recoverable amount, and we saw a bit of that there. So, like I said earlier on, we'll start off with this idea of looking at measurement bases. Most items are held at historical cost. This was the initial concept that we've always had. But we also have current cost is normally only used as an alternative to historical cost. We'll see that as we see later on when we're talking about things like where you have inflation, and then it does start to make sense that, listen, we should be thinking or considering inflation, and of course adjusting our historical cost figures to take inflation into account. Some items, such as revalued assets or investments, may be revalued to fair value, being the realizable value, and sometimes present value may be used in respect of items with cash flows, if you like, receivable in a future period. So the key point here is just we're really trying to appeal, if you like, to relevance with those ones, but historical cost anyway. So traditionally, accounts have been presented using, of course, historical cost convention. We buy the thing, recognize it there at cost, less any amounts depreciate, and we go along. So the key point, the objective of FS financial statements is to provide information about the reporting entity's financial performance and position that is useful to certain types of users for stewardship and making economic decisions. So that's kind of the point, isn't it, with historical? It's easy to ascertain, it's objective, isn't it? The historical cost basis, but the historical cost basis fails to relate directly to any of the following three decisions that might be reasonably made about an asset. This is the problem. Decision one. Sometimes you might want to buy a similar asset of the same age. So you've had an asset, you've had it for, the life is going to be, say, 10 years, and you've had it for, if you like, you've had it for 3 years, for example. And you want to buy an asset, if you like, of the same sort of similar asset, maybe a different model, but close enough, if you like, of the same age. So really, question here is that management might need to know what the current replacement cost is. And of course, models have changed, and so the question here is, what do we do? So, but this is a used asset you're buying, right? But we want to kind of stick with that concept of cost, if you like. And so that's kind of the problem we have, first of all. So because it's a similar age, it's a similar asset, we employ other methods, if you like, or another method referred to as replacement cost method, where we sort of say, I'll just do an example here. We sort of say, well, what would this new asset what would this used asset, what was its original cost value say 3 years ago? So say, for example, right now we're not taking its current market value. We're just saying, well, what would its cost value have been? Say we had bought it 3 years ago, and we take that cost value and depreciate over 10 years, and we use that value in our accounts, is what we're saying. You see, because we want to stick with the cost concept with this method in any way. We're sort of saying, this is our own machine A, but we're buying machine B now, but to recognize it here, we sort of assume and say, well, if we had bought it 3 years ago, it would be this value, and then we then depreciate it as though we had it for the last 3 years, and then we find out what that net book value is, and that's what we put into our accounts. And I think that's kind of the point there with this. And this, of course, is a bit more relevant, if you see what I mean. It's a bit more relevant. Sometimes you might just want the asset might be sold, and if you like, and sometimes the historical cost has absolutely no relationship to the fair value, to the net realizable value, if you like. That's possible because there might be some impairment and a few things going. So, and assets are unique to different organizations. So the fair value might just really just not look anything like the historical cost, as in historical less depreciation. So we're struggling with historical cost here. And finally, this is again, this kind of feels like a value in use type approach where management might need to estimate the future cash flows arising from the asset and discount this to their present value, which is what we do here with. So we're dealing with new types of assets, for example, and clearly there is when I say very little, it shouldn't be, but sometimes you find a discrepancy between this idea of value in use and the historical cost, if you like, written down over a period of time. So the traditional approach to accounting, like I say, has the following features. Accounting transactions are recorded in the original historical monetary amount. Items or events with no monetary transactions have ignored together, which is typically the case. We don't recognize sort of non-monetary, or we have money measurement as an accounting concept. So if we can't measure it with money, we can't recognize it. And so we literally just, again, match income and expense over the period and then depreciate, if you like, over a passage of time. And you can see here it says these features of accounting have served users well over many years. But again, what are the adds here? It's easy to understand, straightforward to produce. They're objective, free from bias. They're reliable, original values. And we typically do not record any gains until we actually realize and when we sell the thing. So those are some of the advantages, right? But where you have prices changing significantly, this is important. Historical costs give you very tricky differences, especially when you're carrying out ratio analysis. So generally, the carrying amount of these non-current assets are substantially lower than current value. But if you like, and you have inventory in the statement reflecting prices at the date, if you like, rather than those current at the year end. So really the income statement doesn't reflect, if you like, you have profits and losses in trade very different to the assets generating them, because we are not updating the value of the asset in line with the type of income and expense that is being caused by this asset. So that's the first problem. So again here, what you eventually fundamentally have is you have this overstatement of profits, if you like, an understatement of assets, and you cannot really calculate your ratios, especially your return on capital employed. Wouldn't call that a very efficient ratio to work with, really, because again, like I say here, you have certain assets that are actually much more valuable or increasing in value potentially, if you like. So again, as a result of the above, users of financial statements find it difficult to assess the company's progress from year to year, or compare different operations. And I mean, there's always, of course, there's the issue of comparability, of course, but there's the issue of comparability, but because if you have one party using sort of historical cost and you have another party using the revaluation method, we have issues there as well. So it's really about being relevant as well, if sort of seeing what are other people in the industry doing so we can compare. So again, remember, we're trying to make sure that users are having the best information possible to work with. Yeah, I mean, this question just kind of highlights some of those issues. So because they're both using historical cost, you have company A. Oops, sorry. Company A uses acquires a new machine in 2004. This machine costs 50 grand. Estimated useful life of 10 years. So company A is nicely, as you would expect, takes us 50 grand and divides it over 10, right? So you have 5,000 each year. And company B buys an identical 1 year old machine, if you like, and then the cost of this machine, if you like, is 48,000, and therefore it has an estimated useful life of 9 years. And you can see straight away that they both have different depreciation amounts. So and again, and their carry amounts, of course, are different, if you like, at the end of the year. So both companies are using identical machines during 2005, but yet the statements show different figures because of sticking to this historical cost. So the truth is, if both companies had basically adjusted their assets to the current value at the beginning of 2005, and then we would have the same, if you like, depreciation going through. But because you have this kind of, so company B is of course current because it's 48, that's at that date, but then company A has stuck with that figure of 50 grand. So really it's that sort of debate problems, those kinds of problems we're seeing. Okay, great stuff. I'll see you in the next video.